Foreign exchange, or Forex market, is the world's largest financial market. The Forex market plays a vital role in the global economy. Every day, trillions of dollars are exchanged from one currency to another. Currency exchange is essential for international business, and the Forex market makes this happen.
So what is Forex exactly? The word Forex is a mashup of foreign exchange and is commonly used to refer to the foreign exchange market, the largest financial market in the world. Picture a massive marketplace trading across all the corners of the globe. But rather than having goods on sale, this market trades in global currencies. The Forex market, or foreign exchange market, is one of the most widely traded markets in the world, with daily trading volume of over $6 trillion. Unlike the stock market, the Forex market is open 24 hours a day, from 5 p.m. Sunday to 5 p.m. Friday, Eastern Time. So you might be wondering, where exactly is the Forex market based? Well, it's actually everywhere. Forex is a decentralized market with no single central authority or exchange that governs it all. Instead, it is made up of a network of banks, brokers, dealers, and even governments who trade currency with each other. Also, make sure to hit the like button, as it allows for our team to continue to produce more free content on YouTube. Let's now go through some of the key concepts you must know. Currency abbreviations. Each currency is represented by a 3-letter code called an ISO code. Here are some of the main currencies traded. USD is the US dollar, also known as simply the dollar. AUD is the Australian dollar, also known as the Aussie. NZD is the New Zealand dollar, also known as the Kiwi. EUR is the euro. CAD is the Canadian dollar, also known as the CAD. GBP is the British pound, also known as simply the pound. JPY is the Japanese yen, also known as simply the yen. CHF is the Swiss franc, also known as simply the Swiss. What is a currency pair? In Forex, currencies are traded in pairs, because when you trade Forex, you are buying one currency while selling another at the same time. Let's look at the pound-dollar currency pair, for example. The first currency in a pair is the base currency, and the second currency is the quote currency. Let's say you get a quote of pound-dollar as 1.2655. This means for every 1 pound, you get 1.2655 of US dollars. There is always an invisible 1 beside the base currency on the left. So here's what happens when you actually trade currency pairs. When you buy a currency pair like the pound dollar, or when you go long on the pound dollar, you're expecting the pound to appreciate while the dollar depreciates. When you sell a currency pair like the pound dollar, or when you go short on the pound dollar, you're expecting the pound to depreciate while the dollar appreciates. Major currency pairs. These are the major currency pairs, which all include the US dollar, as the US is the world's largest economy. Starting out, we recommend sticking to trading major currency pairs, as they are the most liquid, meaning you can get in and out of positions easily and fast, and with tighter bid-ask spreads. What is a pip? In the land of Forex, exchange rate changes are measured in pips. A pip stands for a percentage in point or a price interest point. This is a standardized measurement for the smallest whole unit price move that an exchange rate can make. If the Australian dollar is sitting at 0.6751 and its value gained by 1 pip, it would move to 0.6752. Most currencies are written to the 4th decimal place, with the 4th decimal place representing 1 pip. However, some exceptions buck this trend, such as with the yen-crossed pairs. The Japanese yen is often quoted to 2 decimal places. So a 1 pip gain would be 146.22, rising to 146.23. There's also a pipette, which is a fractional pip that is 1/10 of a pip and is represented by the 5th decimal place. Before we continue, we want to hear from you. Tell us in the comments below right now what video topics we should cover next. As always, please hit the like button, as it allows for our team to continue to produce more free videos on YouTube. So how do people make sense of the Forex market? Well, traders can employ a range of trading strategies, one of which is technical analysis. With technical analysis, traders study historical price movements and data in order to identify similar patterns that have the possibility of repeating themselves in the future. The idea here is history loves to repeat itself. Think of technical analysis like a detective hunting down clues to uncover how an individual acted in the past in order to try and predict how they will act again in a similar way in the future. Here are a few simple examples of technical analysis in action. You look at historical price movement and notice price was making higher highs and higher lows, signaling a moving uptrend. So you believe in the future, price will continue to make higher highs and higher lows. So you want to look for long trades to trade with the moving uptrend. You look at historical price movement and noticed that price was making lower highs and lower lows, signaling a moving downtrend. So you believe in the future, price will continue to make lower highs and lower lows. So you want to look for short trades to trade with the moving downtrend. You look at historical price movement and notice every time price came to this area, it reversed drastically, which means this area is of high interest to buyers and sellers. So you believe in the future, if price comes back to this area, there is a higher percentage chance that price will reverse off of it again, which presents trade opportunities. You look at historical price movement and notice that every time price touched this trend line, it bounced off of it. So you believe in the future, if price comes back to this trend line, it'll bounce off of it again, which presents trade opportunities.
But whether you're interested in trading the Forex market or buying currency ETFs, it's important that you learn more before making a trade. And we're here to help you every step along the way.